You know, at Milken, they always say the best panel for the end of the day. So you guys are in for a real treat, and I think at least 2 of the 4 panelists today have already started drinking early, so maybe I think we can have a little fun today. They gave us a really broad topic here, guys. I mean, the ebb and flow of public markets, and I don't know if you've been walking around the hotel, but, you know, these private capital guys, you know, they've gotten pretty cocky over the last few years. And, I mean, we talk about, you know, I won't say the death of public markets, but they kind of say, oh, the public markets are passé. Everybody's moving into private, but there's still a lot there. And for all that bluster, there's still a big investment strategy tied around that. So maybe we can just start off, and you guys kind of give me your views on just kind of what the state of it is right now, in your view. And I'm going to start with you, George, and because I guess you're in the middle, so you get the first say here.
Well, first of all, thank you, Romain. Kelly and I were just talking about it a few minutes ago. Even after 10 years of a massive bull market in public equity still doesn't get any respect. We feel like we're Rodney Dangerfield, right? What else do we have to do? I'll tell you that there's incredible innovation secularly happening across public markets that makes it still very intriguing to deploy capital in, and I think that's true from a global perspective.
Kelly?
Yeah, I would totally concur. You know, given both the evolution of market structure, with so much of the marginal trading volume being non-fundamental in orientation, with whether that's passive and algorithmic models driving a lot of non-fundamental activity, our view is there's, you know, as an active manager with fundamentally based, you know, very research-driven organization, there's tons of dislocation in the market, lots of opportunity, and I'm sure we'll get into some of the thematics that are, in our opinion, more able to be capitalized upon in the public market structure than they actually are in the private market structure. So we're pretty excited about the outlook for publics.
Todd?
Yeah, look, I think the alpha opportunity set liquidity public markets provide, you know, is as good as it's ever been. I mean, you have had kind of multi-decades of passive impacting markets and allocations moving to privates, but it's still an incredibly robust opportunity set, and we think, you know, especially for an alpha product.
Mm-hmm. And Pedro?
I'll be very biased in my comment. We run like $1.5 trillion of assets under management. 98% of those are in public markets. So I have to believe that there is a future and for public markets, and we still have an edge in investing both passively and actively within our strategies.
Now, that accent, is that Long Island, or is that...
No, exactly? It's not Norwegian,
okay.
It's Portuguese.
Okay, it is Portuguese. Of course, you're running equities for the investment fund that's part of Norway's largest fund. You're not like the other 3 in terms of geography. Why exactly are you here?
Why am I at Milken?
Yes,
Why do we invest?
Yeah.
Well,
not that you're welcome.
It's my first time at Milken, and it's a pleasure to be here. Sure. No, like part of the fund really prides itself for being like the most transparent fund in the world, and we have like actually received an award last year for that, beating CPP. And as part of that transparency efforts, we want to be better known in the US market. We have been like traditionally been a very large investor in Europe. We feel that we are very well known in Europe. We are all equally known in the US, but not to the same degree. So being part of Milken was for us a good opportunity to tell you more about the fund, what we do, why we think that we have a competitive advantage when it comes to active investing.
Now, is it fair to characterize all of you as kind of mostly bottom-up investors, bottom-up managers? If that is true, and when we look at public markets and the need to value things properly, individual companies here, do you feel right now, and I'll pose this to you, Kelly, that there is enough transparency and enough trust and price discovery to do that properly?
I mean, we do. I mean, Reg FD is probably a good thing, and that came to the industry, and it has helped with a lot of disclosure. There's, I think, certain companies who honor it more religiously than others, I'll say. But broadly speaking, I think that disclosure is there's a lot of transparency and disclosure, and we do a lot of work to obviously verify a lot of what we find in public financials through both our own independent work, working with third-party data sources, spending a bunch of time with management teams, researching the people that we're aligned with. So yeah, I think there's a lot of good material to work with.
And what about sort of the number of companies available, right? So when you hear the criticisms that public markets are waning to a certain extent, a lot of people will point to the number of public companies or the number of new public companies, which we know has been declining year to year. Todd, how much does that matter, if at all, for somebody like you?
I don't think we're at a point where it's an issue, right? Look, I would love to have more companies under coverage. We could hire more analysts, deploy more capital. It gives more breadth to the portfolio, the more constituents you can build it with. But we have a very robust public markets in the U.S. We've got good diversification across industries. We haven't had any issues kind of constructing the portfolio, given the number of constituents. I do think, private markets have let companies stay private for longer. They've had more robust capital markets than they've had in the past. I do think what you've seen in private equity and what you've seen in VC over the last 2 years, the cash distributions back to end allocators have been pretty measly. And I think, we do need to get to a place where that changes and shifts, and you start to see companies come public, private equity realizations. I think that would be healthy for the whole system to get that started again. I think allocators have gotten used to a certain amount of cash flow off their privates and would like to get back to those levels. So IPO markets are open for the right companies. I think you need to be a slightly bigger company, but there are a number of very good businesses in private markets that would, I think, have very successful IPOs if they were to come now.
Is the environment right now, George, I'll pose this to you, the environment right now, do you think it's improved for new IPOs, new entrants into the public markets? I mean, because it wasn't good last year.
No, it's definitely not good last year. And if you look at IPOs as a percentage of market capitalization, we're at historical lows. We're definitely at a trough level. It certainly is showing that there's a lot of opportunity out there. If you see market levels in aggregate where they are, the S&P 500 nearly 5,200, global markets are all at very high levels. There's clearly an appetite for paper. I think you've now got a much more, sanguine environment than we had last year that chilled IPOs. Remember, this time last year we were terrified. Silicon Valley went under, Credit Suisse went under. There was tremendous opacity in terms of what's the Fed going to do, what's happening to the economy. We've sailed through it. I think now you hear that we're in a Goldilocks state. I think that's worrisome a little bit that there's too much calmness, but that calmness presents a really nice backdrop for capital raise.
You mentioned last year. I mean, in fact, last year here at Milken, what everyone was talking about were some of the issues with the regional banks, were all those recession calls, 100% chance of recession, which we didn't get. That doesn't mean it's not coming, but we didn't get it. And then the question then becomes, where is the environment right now with interest rates in theory stable, with economic activity, at least here in the US, relatively healthy? Even globally, you can make a case that, with maybe the exception of a couple of countries, we're doing pretty good here. That would seem to suggest here that the next move is probably better, right?
I would guess so.
Yeah.
And I think one of the perversities of the market that we talk a lot about is, if you asked me 5 or 7 years ago, are you going to own a bunch of trillion-dollar market cap companies and they're going to be the ones who are innovating at the fastest rate, who are doing all the most interesting things, I would have told you you're crazy. But that's the market that we have today. And so, to the IPO conversation, the market's not as reliant on those businesses to be leading and establishing the innovation path for public companies because it's become a scale game. I mean, we've been in this panel for 10 minutes and we haven't talked about AI yet, so that feels like a win.
I'm saving that because I assume that's going to dominate the whole conversation.
We can go there now, we can wait till later. You tell me. You're running the show here. But, this is a scale game, and the public market is the best way to express an opinion on that, in our opinion, as a firm. And so what's interesting about that is the biggest companies are getting bigger. They have the data sets, the customer profiles, the capital, and monopoly global businesses that fund all of this exploration into what we believe is going to be transformational technology. And that is just a very different set of facts and dynamics in the public market than we've had for a very long time. And the most bizarre part about it, honestly, is that the prices you're paying to own these market-leading businesses is not exorbitant, which is quite different than what we had, for example, in the late 90s. With the internet boom, you were paying huge prices for speculative things that didn't actually materialize. Our view is that this is very real. It's a question of when and where do the economics accrue ultimately in terms of profit pools, but the big players are the ones who are best positioned to capitalize on this opportunity, and they are all public companies.
What are you basing that valuation on? Is that on traditional metrics, or have you kind of adjusted those metrics for whatever this new age is?
Yeah, so look, we're looking at earnings and cash flow, and that's, I think, you don't have to do spreadsheet gymnastics to justify owning these businesses. And that's the beauty of having these monopoly positions in globally dominant businesses that are funding all of this capital. This is a capital-intensive game. This is not the internet, right? This is not mobile businesses that are being built on top of technology that were better funded in the private market, right? These are billions and tens and hundreds of billions of dollars of capital required, and whether the value accrues at the large language model level, which is not our house view, or at the application layer, which is where we think it ultimately resides, we'll see with the benefit of time. But I think in the interim, you're owning very high quality businesses and not paying for the optionality of what the AI opportunity presents.
All right, well, Kelly, since Kelly, my co-moderator, kicked off the AI conversation, let's just stay there, because I know all of you are kind of involved in this to some degree or another. And I'll start with you, Todd, on this, about kind of the promise of AI, but as an investable opportunity, because we know there's a lot of hype there, but there is substance. Where is that substance?
So I think on the promise side, this is a technology that I do think it solves the productivity issue that we have broadly in the economy, right? I mean, there's a lot to be figured out, but it is a technology that I think goes to the core of making corporations more efficient, right? Once we figure out how to deploy it. I think there's a lot to be figured out. Right now, the way we see it running through the portfolio in different coverage universes for our analysts is really more kind of supplying the picks and shovels to the CapEx cycle that's running through AI. That's where we see the kind of the best risk-reward trades, investment opportunities, understanding kind of, you know, it's been fascinating to me. Everybody's kind of talked about the momentum factor year to date and the performance you've had, the momentum factor. We look at factors on a sector basis for momentum, and it's actually industrials momentum that is the best performing momentum factor. It's not technology. And it's being driven by electrification. It's being driven by people who are kind of selling into the data centers, cooling systems, all that kind of stuff. So that's where we're playing it for the most part right now, are on those cycles. It's a little early days, I think, to understand who the winners are going to be in the large language models. I do think there's, you know, I think the large tech players have all the resources to win there. I wouldn't kind of debate that. But this does feel a little bit like, to me, you know, in the early internet boom, you know, laying fiber, right? You're spending a lot of CapEx with the hope that you're going to get a return. And it's unclear. I know that the returns are going to be made, but it's not clear by the people that's spending the CapEx or by the people who come after.
Well, that's what I'm curious about. You used the analogy of laying the fiber. I mean, how many of those companies are still around? But I mean, to you, George, I mean, are you finding opportunities, at least attractive opportunities, I should say, in the AI space?
So there are real opportunities in AI space, and there's real risks as well. So the AI opportunities are multifaceted, and that's one of the key dynamics to be playing out. There's a convergence, given scale, to the big scale players. So if you think about the biggest companies in the world, the big difference between now and the TMT bubble is these are companies that are generating a ton of cash, have cash-rich balance sheets, and are reinvesting that cash massively. That is creating massive scale benefits and are monopolistic benefits. At the same token, AI is presenting competitive disintermediation opportunities for non-traditional players. And so you have to be thinking about this from a multidimensional perspective of it's scaling up the biggest players, but who are the other incumbents that are about to get disintermediated pretty significantly. And from an investment perspective, it's both creating massive opportunity and risk across the lateral spectrum.
Pedro, is Norway also pushing into this space? Have you made investments there already?
Yes, as you can imagine. As a larger asset owner, we do own a lot of these companies. No, our view on AI is relatively like simple at this stage. I think that we have to stay really humble in not overestimating our predictive ability. It's really a technological revolution that the consequences of which we still have to wait for another 10 to 20 years in really to grasp how profound that will be. It will have immense economic and societal consequences, and the way that we've been approaching has been mainly in three ways. So the way that we think about three key uncertainties in that space. One is the ownership of foundational models and software infrastructure. Secondly, around the competitive landscape within silicon infrastructure. So really to see if there's going to be a dominant technology, NVIDIA, or if there's still like room for others like to chip in. And thirdly, on the ownership of intellectual property and data. And the jury is still like very much out. I fully agree with the comments that you made about like the analogy with TMT, i.e. the incumbents of the internet revolution were not really the ultimate winners. I mean, who remembers boo.com or webvan, where they are now? But at the same time, the market underestimated the longevity and the compounding effect of some other players. I mean, Amazon is 32 times above the peak out of the dot-com bubble. So we really have to be cognizant of those uncertainties. Try like a portfolio approach to these themes, so like trying to focus on companies that can win in multiple scenarios, or try to focus on companies or a large number of companies that will win in discrete scenarios.
Are you finding those companies primarily in the US, Asia, Europe, where?
I mean, there is a big unevenness in the competitive landscape of winners, or at least the ones that we can immediately identify between the US and Europe and Asia.
Yeah.
We try like to separate winners and losers, but it's quite hard at this stage.
It is. I mean, but Kelly, I mean, we talk about the companies that dominate, or at least the ones we talk about a lot. Obviously, they're mostly US-centric, with exception of a few companies over there in Asia, and I guess a big chip firm out there in Europe here. But do you think we're going to start to see more global investment opportunities in the AI space, that we don't just have to maybe look to the homegrown US companies?
I think we don't know, is sort of the honest answer. And I think what makes it really hard is right now we're very focused on the foundational piece and all the capital required to build that. And what's difficult, and we talk about a lot how we're going to track whether there's a return being generated on all of this spend. And the complexity around that lies in the fact that there's not distinct line items for most companies, in getting away from picks and shovels and talking about sort of a higher value add, that says AI revenue, right? The way that the tools so far are being deployed is to make existing products meaningfully better. So when you talk to people at Meta, when you talk to people at Google, what's amazing is hearing them describe how these capabilities are enhancing core products, their core business. So how do you isolate the revenue contribution from that to justify the capital expenditures that are going into all of these GPUs and other infrastructure build? It's very difficult, right? And so there's a little bit of a trust me factor that there are returns being generated, and it's creating more stickiness, pricing power, innovation within these very large companies. Hard for somebody new to, greenfield, kind of compete with that without having the same resources from a financial perspective, and also intelligence that comes from having very large global captive customer bases, which are effectively their research laboratories, right?
Yeah.
So it's hard to know.
Yeah. On the topic, though, of AI, and it really dovetails, I think, with just sort of the theme of this panel, there is sort of an issue with public versus private here, right? I mean, one of the reasons why we talk about the same companies over and over again, there's really only so many public companies that are in this space, or at least have identified some sort of niche in this space here. There's a ton of private companies out there doing this here. And Todd, I'm just curious. I mean, I know we're talking about public markets here, but how do you bridge that gap? If you're looking over the fence and you see all these companies, are you just waiting for them to finally find that exit ramp to the public markets, or do you just say, I'm just going to jump the fence and invest privately?
We aren't a crossover fund, so we're very much focused on public markets. We've got a coverage model, so the way we kind of think about the opportunity set is the analyst is a unit of production for us. They cover 30 to 50 names. It's a static 30 to 50 names. And we want them to be experts on those businesses. If there's a competitor in private markets, they're usually aware of it and kind of covering it from afar, but it's not an investment opportunity for us. With the recognition that they may come public, right? At some point, one of their companies may buy one of those names. But it really is kind of, that coverage model. And I think broadly the AI thing, there are the AI-specific companies, but this is going to touch every industry. This is going to reshape profit modes across industries. And people who figure out how to adopt the technology early, how to use it to kind of be either more efficient on the cost side or drive revenue, I think in a lot of industries, you're not going to hear them talk about it. If I were kind of in the automotive retail business and I figured out how to use AI to better manage my SKUs, you wouldn't hear me on a conference call telling anyone I'd figured that out, right? So our job for our analysts is kind of figure out who's going to utilize this technology for competitive advantage. Is that a kind of long duration competitive advantage that's going to drive kind of a relative earnings revision cycle versus somebody else in their space?
One aspect of this, before we move on to other topics, with regards to AI, that we have to talk about are some of the, I guess, I don't know, regulatory issues, but more importantly, I guess, sort of the national interests, the protection issues, I guess is maybe a better way to describe it. We're developing these great technologies, but we have governments saying we don't actually want to share that technology with anyone outside our borders. So does that complicate the investment thesis that you have to come up with? I mean, do you have to really look at that and say, this is a great product, but are they going to be able to scale this past the US, or if it's a European company, past the Europe, or if it's a Chinese company outside of China? Pedro?
Well, I think that governments have been very early on the way that they have jumped into what's happening on the AI landscape, and that may slow down development. So that's definitely a concern to have. To the extent that excessive regulation would really hamper the prospects of accelerated growth.
Yeah, but do you have confidence, George, that the way AI is being developed and the companies that are developing them, that this will end up being, I guess, truly cross-border in a way, or will it be more segmented?
Boy, it's a great question whether or not we're going to be cross-border or not. Initial reactions are that I do think it has to be across borders. There are geopolitical ramifications, and so one of the things that we've seen, and this is going back a few years now, the United States, Taiwan, and the Netherlands have engaged in basically a semiconductor almost closure pact where they've agreed not to deploy semiconductor capital equipment high-end to China. So why the Netherlands and why Taiwan? Taiwan Semiconductor, ASML. They are the enablers of high-end compute, right? And that's been going on for years. So it's clearly indicating that you're going to have a geopolitical segmentation of where high-end compute, including AI, is going to be. It does make the dynamic more challenging, and we'll see what evolves from this. But given the scale economics and the compound economics that are happening here, it's hard to argue that it's not going to be proliferative.
Just one thing to add on is just while you were speaking, I was thinking about business model implications of that question. And so one of the things we talk a bunch about internally is open source versus closed, right? So what Meta's doing with Llama, open source, obviously no charge associated with that, versus LLMs, which in most cases are for profit in some way. And so what are the implications of that in terms of going cross-border and having open access?
Yeah, Todd, any last thoughts on this?
Look, I think the other big trend is kind of a trend towards a multipolar world, right? And it's not surprising that kind of AI gets caught up in that. I do think you've got kind of views on trade have changed, and that's causing kind of more friction in the system. And it's not surprising to me that AI is going to be another piece of that puzzle we have to figure out.
Yeah, well, that's a nice segue. We have some questions from the audience. I'm just going to kind of weave them in from time to time when it becomes appropriate. And if you have questions, just use the QR code and submit them. It kind of comes through the magic of the iPad here, and I can pose them to the panelists. But I do want to stay on international for a second here. And a question from the audience here is, he or she wants to hear your views on China and India. And I think it's better if we start with China first, because it kind of dovetails some of the issues with AI and the technology and whatever the heck is going on between the US and China here. Is China, for you all, is it still investable? Was it ever investable for you?
I can start. It is investable for us. I mean, we cannot, as a global equity owner, as I said in the beginning, a large asset owner, we cannot ignore China. So around 3% of our assets are in China. It has been going through a very rough period in terms of unlove from the markets. It seemed to have turned a bit the corner, at least over the last month and a half. People will be well versed with what has been happening over the last 3 years. But I think that thinking that China is uninvestable is really where the opportunity may be.
George?
So I think China is actually quite compelling right now. Look, we all know that China is risky. Everybody knows China is risky, especially coming from a Western, a US, European dynamic, it's clearly opaque. There's clearly geopolitical tensions. Regulatory changes happen all the time. Well, that's been the case for a long time. What's interesting now is that the negativity towards China has gotten to an extreme levels. So China's trading as cheap as it ever has as a function of current free cash flows. There's still a lot of dynamism that's happening there, innovation that's happening there. There's growth. You're seeing much better regulatory environment, a much more pro-business stance by the government. You're seeing companies act in a much more shareholder-friendly way. If you were to go back a decade ago, they were just acquiring hand over fist. There didn't seem to be any strategy other than we've got money, we're just gonna go buy stuff with it. Now you're seeing buybacks, you're seeing dividends increasing. You're seeing a thoughtfulness that hasn't occurred before, and at the same time, they've never been cheaper, right? You're looking at on current free cash flow yields in the mid to upper teens, and these are growing. These are indicative of true bear market, worriness. And I think as a contrast, India, which I think is incredibly dynamic and attractive, but still in a very early developing stage, has benefited from all of the capital moving out of China, has gone and found India. And in fact, if you look at EM flows are negative, but if you look at EM ex China, they're flat. And so all that money is just really transferred out of China into elsewhere, primarily into India. India is a little bit tougher. Even with all the cool stuff happening there, those valuations seem, let's say, more optimistic, and I think it's creating a compelling opportunity for a longer-term investor in China.
Interesting. You feel the same way, Kelly, or not?
We do not. I agree with that the valuations are compelling. My struggle is what's the valuation framework or paradigm that I should use? Particularly because a lot of the companies, and just backing up, we are global investors. We've had at one moment in time in our 26-year history as much as a quarter of the fund in China. Not recently. We've been out for 3 years and are struggling to get engaged there just because I'm trying to pick stocks against a backdrop that's non-fundamental, and I've seen things happen in the last handful of years of, let's talk about the for-profit education stocks in that space. With stroke of pen, the entire sector was wiped out. And so I don't know how to apply appropriate discount for that risk.
Right.
And furthermore, the companies that we have owned in that market historically are just more mature in their life cycle, so they don't have the same rate and level of innovation and growth. They're profitable and they screen attractively on a free cash flow, but I don't have confidence in the prospects in front of them. And for the global businesses that are domiciled there, I think there's potential political blowback in terms of their ability to operate successfully with non-Chinese partners, which will limit, again, how to think about that growth algorithm going forward, which further complicates my ability to value the business.
Would your confidence be improved if we had more listings of Chinese companies here in the US, meaning they would also be more beholden to SEC disclosure rules, et cetera, or no?
No.
No. Wow. Todd?
We don't have a business in China, and we don't spend a lot of time thinking about country allocation risk, right? We're very much kind of bottoms up. And we do need kind of a robust short side of the portfolio. We're running a market neutral strategy. So we haven't spent a ton of time trying to figure out the China problem, actually any time trying to figure out the China problem. We're much more focused on kind of building out the coverage frameworks in the US.
Yeah, and it gets to the two, and I think, George, you kind of mentioned India too, and where some of the money is going. I mean, China was the growth story, at least it was supposed to be the growth story. We send a lot of money, cycle out of that into other parts of Asia and EM space. Obviously, India's been a big beneficiary of that. Is that a chase that you find legitimate, or is it kind of like fool's gold?
So I don't think it's fool's gold in terms of these are real companies that are doing, that are growing rapidly and doing innovative things. It's very hard to make the math work on a lot of these valuations. You're paying 50, 60, 70 times earnings for companies that are growing organically in the mid-single digits. That is hard to do. Whereas, let me contrast it with China. You're finding companies that are growing at least that much, if not faster, on an organic basis, that are priced in mid-single digit PEs. And look, I get the notion that there's still regulatory uncertainty, right? But the same notion, those for-profit educational companies that Kelly mentioned, we did the same thing in the United States a decade ago.
We did.
Right? And so from my perspective, there is risk everywhere. Are you getting paid to take thoughtful risk? And I think right now there's just this very reflexive, I'm not going there because it's China, and I get it, it's risky, but if you actually look on an underlying perspective and underwrite from a fundamental perspective, these businesses, they're pretty cool. And oh, by the way, they don't need to sell in the West because their home country is well over $1 billion. And so you've already got scale economics that are significantly greater than the US or anything on the continent. I think it's compelling, and I think I think we've gotten a little bit, and I think it's just benefited from a market structural perspective.
Yeah.
Well, I've spent very little time thinking about China. I always find it interesting in the China conversations that people come to the demographic issues last, right? And they probably should be first, right? I mean, at the end of the day, the demographic issues that China are going through are incredibly significant, right? Population's going to be halved, I think, over the next 50 years. India's the inverse of that, right? So, you know, they have regulatory overhang issues, but they also have a very significant demographic issue.
Pedro?
I was just going to weigh in with an additional comment when it comes to investment in China and in India, as you were asking, and just like to go back to my comment initially of the 3 to 4% allocated to China. Even if we have a very strong internal competence when it comes to active investing internally by our portfolio managers, we have also up to 5% of the fund invested through external managers. And why do I say that? Because it's very important in those economies to have the local presence, the local knowledge, to get that added conviction that we were discussing before. So part of our allocation is not just top-down, it's a mix of top-down and bottom-up with very strong local knowledge by the external managers that we allocate some money to.
Yeah, that's a great point. And I'm going to squeeze in another audience question because it gets to the whole idea of you guys being fundamental, bottom-up folks. And this person is asking whether you at all incorporate any sort of quantitative capabilities into your investment process. Anyone?
Yeah, so for us, it's kind of a central part of what we do, right? As I said, we kind of organize our teams by analysts. We ask our analysts to construct highly idiosyncratic portfolios using a custom risk model to kind of pull out all of the factor tilts that you could see through portfolio construction. This is a process we kind of started at Citadel when I was there a long time ago. I think as you've seen the rise of passive in markets, being able to strip out factor performance just gives you a much better lens of what is actually being valued in a company, right? You see kind of quite a bit of volatility in factor space that can distort valuation. So we think, the future really of fundamental analysis was wrapping it with a risk model and being able to understand really, truly, what is the company's specific risk? What has that company done? How is it delivered? Removing all the other things that come with being a public company.
Well, it's funny you bring that up. I think maybe it was just yesterday or the day before, forgive me, David Einhorn was making a comment about the role of passive investing and in his view, how he thinks it's really distorting the public markets in a big way. And I am curious whether you'll, if you feel that way, but more importantly, what is going to be the role of passive? Is it just going to get bigger? Is this just kind of a juggernaut that never stops? And if so, to Todd's point, where does that leave you as an investor? As an active investor, sorry.
I think it benefits those of us who have duration, honestly, because there's so many non-fundamental setup-oriented dynamics that happen around events now, which is, having been in this business for 20-something years at this point, you used to be able to study a company. You would print out the press release for me when they report, and I would tell you how the stock was going to react. That exercise is an exercise in futility today because it all depends on what are the third-party data sources saying, what's the whisper number. They were at a conference 5 minutes ago and they told people this, and that now is a set of expectations. And so you read the release, and on a fundamental basis, I can give you the answer, but that might be entirely wrong. And so for those of us who have duration on our side and are taking a longer-term view, there's dislocations that are non-fundamental that we can capitalize on. However, from a portfolio construction perspective, the outgrowth of that is we have to think about exposure differently and how we size things differently, because you can't be fully sized and fully expressed perhaps in the same way that you would have historically because of these dynamics. You want to have gross and net exposure and position sizing that leaves you some room because these non-fundamental things are happening very frequently in the market, and you want to be able to lean into them as opposed to playing defense in those moments.
Yeah, I would share that I think the continued rush into passive, which has occurred for the last couple of decades now, I think creates massive opportunity for folks who do fundamental investing, who understand the companies and the securities they're investing in, and can take advantage of all these near-term disturbances. Right? Most people flee from volatility. We don't want to invest in public markets because they're volatile. That to me is an unbelievable opportunity to buy assets more cheaply than you could otherwise, right? Let the market make decisions based on short-term factors that have nothing to do with long-term worth of a company. I want to take the other side of that trade all day long. And I think that's a massive opportunity. And I think the market structures and the truncation of time horizons is playing to our benefit. And then if I can quickly add, people are hoarding into private equity because of the durational argument. And they're smoothing, what have you. Well, there's no real smoothing. We're just not marking them. We're not marking it to market. And we're transferring liquidity and sell discipline from the actual investor to the investment manager, right? Well, that provides massive opportunities for those of us who are playing in liquid markets to take advantage of that. And we too can be long-term oriented. We can go ahead and act in a counter-cyclical way, create massive benefits for our clients over, again, long-duration time periods.
Are you able to make that argument, though, to clients? And I mean, you only really have one client, but...
Well, it's 5.5 million of them, but like at an in one. But I couldn't agree more, just to say, we see it definitely as an opportunity, and even only... If only around like 20% of our capital is really like managed actively, that is a massive opportunity for us. I mean, like the long-term nature of our capital, the fact that we don't have daily, monthly, weekly liquidity needs, allow us to think long-term, allow us to be contrarian, allow us to be patient and opportunistic when the opportunities come.
I do think that the kind of rise of passive is just the inevitable conclusion of applied mathematical theory to financial markets, right? I mean, you shouldn't have to pay for beta. It's an exposure you should be able to get fairly cheaply. I think investors are well served by the growth of passive to kind of get that exposure to risk premium at the lowest possible cost. You still need in capital markets a robust system to price company-specific risk. Right? And long-onlys used to provide that function in a much more fulsome way, I think, active long-onlys in public markets. There is still a robust system of people who care about idiosyncratic risk, who are that pricing engine of Home Depot versus Target, right? And there should be skill that can be rewarded for understanding these businesses, their strategies, their competitive advantage, and also what the market's implying in valuations, right? So I think there's still a lot of alpha that can be made from that part of the market.
Right.
People shouldn't be paid exorbitant fees for giving you beta exposure. And that's not a bad thing that's gone away.
That's a good point. And I've got 3 questions that are all kind of on the same topic, so I'm just going to kind of mash them up, and they're all about kind of crowding in certain positions. And I'm going to set this up in a very loaded way, which is we talk about fundamental bottom-up invest. How many people are really doing that, though? Because I know people say they are, but it also seems at times that people are just kind of following the crowd. I mean, maybe they're doing some diligence on their own, but there does seem to be a lot of just monkey see, monkey do. And I wonder if that creates distortions as well. And I know you have opinions, George. Do you want to go first, or should I let everyone go first so you can rant after that?
Romain, thank you. So I definitely have an opinion here. I think if you were to go back 2 decades ago and look at trading activity in the U.S., roughly speaking, 3/4 of that trading activity was delivered by fundamental-oriented investors, long shorts, long onlys. They were the dominant players. They were doing the underwriting on what's the price should I pay for these units of growth. If you look at it today, it's completely flipped. It's systematics that are a huge part of the market, and it's also retail money. Retail money coming in very short duration. One of the scariest market substructure issues that are out there right now is that today we're seeing roughly $20 trillion of option trading activity a day, and 49% of that, so almost 10 trillion a day, are 0-day trades. So we're seeing all sorts of short-termism in the market. We're not seeing the aggregate market invest on a fundamental perspective like it did a few decades ago. And so you're seeing, as a function, a lot of herding, a lot of momentum. It is very quick. We're going to follow and do this. And I think it creates a massive arbitrage for those of us who can take the time, underwrite what we're buying, and invest our clients' money in that way.
Say 2 different observations that perhaps go together, perhaps don't. I mean, one is that the consensus often gets it right. And so maybe there's crowding, and maybe we want to talk about the Mag 7, but the execution for many of those companies has been phenomenal, and the stock price activity is deserved, in our opinion. largely. So sometimes, everyone likes to be highly differentiated in their theses and counter consensus, and that can be right and productive and profitable. But I would also make the observation that, let's pick on Apple. Apple was a consensus long for 2 decades and has been right for 2 decades, right?
Yeah.
So you could pick apart parts of that thesis and poke holes, but owning it's been a good thing. That's one thing. The second thing I would say, which is perhaps related, is all of the narrative publicly around the Mag 7 and crowding and one series of stocks and AI as a thematic has, in our opinion, created lots of interesting investment opportunities away from that. And so there's incredible businesses hiding in plain sight, trading at very fair multiples that are executing incredibly well. And with the cost of capital that we now have in the market, there's real winners and losers in a dynamic now that we haven't seen really for almost 15 years of being public market investors. And so it's an exciting time to be a public market investor because you've got thematic things which are establishing market leadership, which we think are both fundamentally interesting and priced relatively attractively. And then lots of other sectors that we've been looking at for many, many years, and execution's fantastic and lots of runway in front of these companies, and they have nothing to do with AI and nobody wants to talk about them.
So what we found is, I think all investing is a time allocation problem you're trying to solve, right? There's only a fixed amount of hours in the day that you can spend researching. Where you spend that research time is going to determine a lot of what your forward returns look like. And what we found is if we can focus people on a static set of names to become experts on, you get actually less crowding in the portfolio. If you have somebody who's covering 100 names, 120 names, they're not really covering 120 names. They don't have models on them. They're not in the details.
They don't know them all equally.
They don't know them equally, right? And how they sort the 25 that are in their portfolio, I ask this every time I interview people, and there's really only 2 answers to that question. One is, I look at what's moving, and it's some form of momentum investing, right? I look at what's breaking out. The other is, I've got this amazing network of people that tell me what to go look at. So it's like either crowding or mow. It's one of the 2, right? And so you get much more thematic portfolios the wider you make that aperture, right? And so our goal is to kind of make sure that we kind of narrow that down, give people a list of names to look at that we think is feasible to be on top of all the details. And then the opportunity sets change from year to year. Sometimes there's great things to do there, lots of money to be made. Other times it's blood from a stone, right? But if you stay where you are, you have a much better chance of catching the opportunity set when it comes back to you, right? It's in the nature of the analyst to go say, it's really hard in this space this year. If I could have just covered internet, I would have picked the winners and the losers, and I would have made a bunch of money.
Right.
Inevitably, if you let them do that, they get the last 2 innings of the trade, and it becomes a good opportunity set and all the stuff they left.
What about the unwinding of the trade? Because that's some of the concern when it comes to crowding. It isn't just the upside, it's that what happens when everyone decides to head through the door. And one of the audience members is actually asking about kind of the growth of these multi-manager funds and risk correlations, and whether if there is the kind of that alpha shock, if it comes along, is that really going to be kind of the downfall for a lot of folks?
Well, I think that the proliferation of multi-strategy managers is quite evident over the last years, and they've been crowding out the more traditional, as you were saying, company fundamental long-short strategies that were prevailing in the 10 years ago, 15 years ago. I think that game is becoming very overcrowded. I think that the trading around short-term catalysts, earnings, to the point that was made before, is very relevant. And I think that the ones that can withstand those shocks, that can sit on the sidelines and benefit from that, we'll see that fall with great pleasure.
Yeah. I spent some time dealing with the multi-manager, so I got some views here. Look, I do think the classification of multi-managers doesn't do us a lot of help here. There's a lot more difference in these business models than I think people give them credit for. I mean, the kind of key technology innovation of the multi-managers is basic portfolio theory of if I have a set of idiosyncratic revenue streams and I add another one, I see my Sharpe ratio increase by the square root of n number of strategies, right? There is a cap to that because these things are correlated, but that's really the only thing they share is that kind of technology and how the business is structured. There are very big differences in how they allocate capital, how they ask their teams to function, how they ask their analysts to cover companies that I think drive very different outcomes. So, I think it's been very easy to kind of lump them into a group, but I do think there's a lot more nuance there.
Mm-hmm. I want to pivot to another question, and this is really about kind of the macro environment and really the uncertainty around it. And I don't really want any of your predictions specifically on the economy or anything, but as you're trying to look long term, and you were talking a little bit earlier, Kelly, about long duration. In equities, and if we are in a sort of this big structural change in our economy, whether it's because of AI or something else, or trade wars or geopolitics or whatever, I mean, what gives you the confidence or I guess some degree of certainty that that duration is not going to work against you?
Would you like me to start?
Yeah, sure, why not?
So look, this cycle's pretty different, right? When I think and reflect back across other hiking cycles that I've been witness to in my career and even prior, they end in crisis. And our investment careers on this stage have been punctuated by crisis, starting the Asian crisis, 9/11, financial crisis, the housing bubble, right? And what's different about this is I don't see a crisis. I mean, there's a lot of turmoil in the world. I don't want to discount that, and it's very real. But when I think about disruptive financial market crisis, I don't see the thing that's coming. And when we think about fundamental investing and backdrop, many of the positions inside of our long book today are exposed to sectors that have already been in their recession. Or when I think about end markets, right, I think about the advertising market post-IDFA. I think about what happened with travel during COVID and coming out the other side. I think about supply chain disruptions that really hurt many industries that couldn't get parts and service done, right, to get product into the market. Those markets have all bottomed or in some varying phase of recovery. And so when I think about the outlook and this sort of doomsday scenario, we're about to go into a deep recession, maybe by some crisis that we can't see, or just rampant and pervasive slowing from an end market perspective when I look across industries, I just don't see it.
Yeah. How often do you guys at all sort of map out sort of alternative macro scenarios when you're making these picks? I mean, it's fundamental, it's bottom up, but at some point, are you looking at the top down, or at least looking at the scenarios, various scenarios?
So Romain, from my perspective, it's less about, our skill set isn't picking macro, but we have to understand macro. I think a good way of thinking about it is, if you're going to go outside for a run, you look outside, see what the weather's like before you decide what to wear. Yeah. So you have to understand the macro backdrop, but you should be investing in companies that are resilient to whatever the environment's going to provide.
Yes, because it's really around increasing awareness, increasing preparedness. The way that our mandate works and our benchmark works, it limits the extent of country deviations. We are a minority holder of the world, given that on average we own 1.5% of all equities that are listed. So if you are a minority owner of the world, there is no place to hide. Which is quite problematic.
Yeah. That sounds very ominous.
Exactly. In the face of geopolitical risks is quite concerning. So what we can do, we can raise our preparedness, we can raise our awareness, we can do our stress testing. We have a top-down scenario in which, on a divided world, the fund market value would drop by around 30%. But it's a number, it's a guidance, and something that we can try to manage our expectations against.
Are you all nervous at all about kind of the current state of geopolitics of the world right now? And we've got a pretty consequential election here in the US, but of course, around the world, we've seen some pretty controversial elections that are really going to reshape public policy and, to a certain extent, financial markets and the economy down the road. Are you worried?
I would say that my confidence in what the world is going to look like in 5 or 10 years is pretty low. But it actually makes me excited for our strategy, right? We deal well with uncertainty, right? If I kind of go back to the kind of COVID and the depths of COVID, we were able to generate very good returns in the back half of the year, and it was all from the ideas that we put on in those 2 weeks around COVID, right? So when there are big dislocations, that's the benefit of public market investing. You can reprice your risk very quickly and adapt to the kind of what is the new state of the world. And that's where some of our best ideas come. So, I do think there's definitely kind of a lack of transparency on how AI is going to play out, how the election cycle will play out, how geopolitical situations will play out. But I think that plays to our advantage, especially relative to private markets.
When we talk about investment themes and when we spend a lot of time talking about AI, there's got to be something else out there other than just AI in terms of those big overarching, structurally changing themes out there. Are you finding that outside of AI? Anyone?
I think there's a lot of themes at the sub-industry level, either regulatory backdrops that are driving changes in industries. GLP-1s are one that we would have talked about last year, and quite a bit of depth.
I've been meaning to try that.
But those are going to drive significant changes across healthcare consumption in many different ways, and consumer preferences. So there's some big ones that are going to drive kind of a lot of change in behaviors that should create opportunities.
One of the big things we've spent a bunch of time on internally is just the sort of institutionalization of the alternatives class as a public market sector, right? You've got a bunch of companies that have come public in the last handful of years. I mean, Blackstone's been public for a while, but you've got, almost $500 billion of market cap now in alts. These are companies that haven't really been battle tested as public market companies yet.
Right.
They're very strong platforms that are, strong marketing, innovation, product cycles. They've got great distribution, great relationships, and that world is consolidating massively from an AUM perspective, and now starting to pursue retail. And so, just in the beginning phases of getting added to indices, I think just capturing the attention of kind of the fundamental long-only community, which has not really paid that much attention to these businesses thus far. But there's a whole asset class sort of being created in the public market domain that is new, and we think is pretty interesting.
Well, I'm glad you brought up that theme. Before I get to George, I would want to get your thoughts on that, because we've seen a lot of new products come down the pipe, whether it's the actual companies themselves going public, whether it's the business development companies going public, or whether it's like these new ETFs that are basically sort of a wrapper for companies that are still private, and these are more, closed-end funds, and it's a totally different animal here. But I'm wondering what you make of that. I mean, do you think those are going to be effective vehicles for the private space in the public markets?
We do. I mean, we're most focused in the list that you mentioned on the platforms, and there's a flywheel that is happening from a capital raising, product innovation, talent hiring and retention, scale dynamic that is clearly benefiting these businesses. And there are pools of capital in the world. We've got one alongside of us on stage here that need scaled managers to help them invest their capital thoughtfully. And these are incredibly responsive organizations that are sitting down with the sovereign wealth funds and other big sources of capital in the world and figuring out what are the unmet needs and creating products that accommodate those needs. So there's a real role, I think, in the world for these businesses. And it's another example of, scale begets scale, and it's hard to compete with them.
So Romain, if I can just maybe take this a little bit of a different direction, because we've heard, elements of innovation, and I think there's so many different ways that innovation's occurring. But I think one of the things that is occurring, a big benefit, is very old school, and that's in the mining sector, right? In commodity.
Mining?
Mining,
okay.
Right, which no one's seeing, but for example, copper. You need copper for the future, for electronification, for industrialization, and all of that's happening dramatically. Microsoft is looking at building a $100 billion data center. Yes. You are going to need tons of copper to enable that. And what's happened is, in the prior decade, you essentially saw a shutdown of all mining development because you were in such a bear market. Companies were going out of business. Companies that were existing were cutting CapEx to the bone. They weren't even replenishing maintenance CapEx. And so you're now in a situation where the world is underinvested in commodities like copper for over a decade. And now we need it. And now we need it for the greening of the world and environmental regulations and strictures going forward. We need it to help us industrialize. We need it to help us enable high-end compute, and we don't have it. And it's not like you can, first of all, assuming you can get permitted for a copper mine, which is going to be really difficult.
In the US?
It's not going to happen. We turned it down in Arizona a few years ago. Good luck. And then if you even get permitted, it's a minimum of 5 years before you can adapt a current mine. It's 10 years before you can go de novo and greenfield this. So we're in a massive supply dearth situation. And so if you're thinking about this from an investment duration perspective, duration is on your side because you've got supply that's degrading. You're pulling it out of the ground, and what you are pulling out is less, and it's lesser quality, and the world needs more of it. And again, all this stuff that's out there that is really cool and innovative, everyone's hurting there, and it's not wrong, but it's leaving this massive opportunity in things like mining.
You mentioned like before China as a contrarian bet. I think that in terms of like big thematics, we really need to search for where people are trying to avoid, and like think contrarian. I think that like part of the green transition companies that were very en vogue 5 years ago, ESG has become a dirty word in many places in the world. But there might be opportunities on the renewable energy sector, like very punished by the increase in rates. By the disruption in supply chains, by cost inflation, by questions around affordability. So that could be like an interesting hunting ground as well for contrarian opportunities.
All right, we just have a few minutes left, and I'm going to do two things here. I'm going to put you on the spot.
Even more?
Even more, but you held on there, so this is good. One audience member had a question about talent and what type of talent you look for, and I want to kind of put that in the context, particularly of the younger talent, sort of the next generation of Todd's, Kelly's, George's, and Pedro's. Like, what is going to be most important for, if you were looking at that person to hire them, what's kind of the biggest thing that matters most to you?
I can start. I think like curiosity has always been a big asset to have, and the relentless willingness to improve, ongoing learning. And without wanting like to sound too old for the younger generations, I think patience as well.
Yeah, so I agree with everything Pedro said. I would add persistence, the dogged desire to keep digging to find answers, to keep digging and to persevere during challenging periods when you're looking for underwriting. I think that's going to be a critical element that will separate talent, as you see people come into the profession.
Kelly?
Curiosity is always my number one answer, but 2 and 3 are close behind. 2 would be resilience. So I love hiring people who went to colleges I've never heard of, worked 3 jobs, were valedictorian of their class, because they're jugglers. And our job is about juggling and prioritizing and time management. And then the third would be, behind those 2, would be a balance of IQ and EQ. I think EQ is an incredibly important part of what we do. It's so much of it is around relationships. We're in the information gathering business, and getting people to connect with you, relate to you, trust you, assessing management teams, how they motivate people, how they partner with their team, how do they retain them, how do they pay them. There's so much about what we do that is beyond a spreadsheet. And I have found the most successful people that we have hired and managed to retain have a good balance of the 2 and know when to distort to one or the other in terms of solving a problem.
Yeah, I would agree with all those comments. I mean, for us, this is a business that you're wrong a lot, and you have to kind of find people who, when they're wrong, don't look for externalities to blame for being wrong, but figure out how to get better.
Or hide under their desk.
Yeah, or hide under the desk, but figure out, how do I improve my process? How do I iterate? How do I not make this mistake again, right? And a lot of the job also, sometimes, you have a bad outcome, but it's good process. And being able to distinguish between those 2 things and understand, what you're playing for. But it is that resiliency, competitiveness, that grit, that I think is one of the qualities we're always looking for.
Yeah, well said, and I think that's a great place to end it. And I just want to say, in all sincerity, all 4 of you really the best in the business, and I think anyone looking to work for you would definitely be a privilege to do that, and it's a privilege to have all 4 of you here on stage today. Let's give it up here for Pedro, George, Kelly, and Todd.
Thank you.
Thanks, guys.